Stop losing money with bad discount strategies. Real economic impact of discount strategy, it's something that gets easily missed.
And you don't want to, succumb to margin erosion by discounting things that you don't need to discount.
Between 5 and 10% of your ad spend per month should be roughly allocated to the development of net new assets. Welcome back to the Ecom Weekly podcast, where we'll be talking all things ecom. I'm joined here by Liam Verrigan, one of my co-founders. Liam, do you want to give a quick intro on your side?
Yep, absolutely. So one of the co-founders of Aplo, more so oversee what we do on the auditing, pitching, bringing new brands on board, diving into proposals for them based off of our audits, et cetera, and a bit on the recruiting side.
Awesome. So today on the docket, Liam and I are going to be chatting bad discount strategies to avoid, discount strategies to leverage. We're going to be chatting next about set and forget flows. So why bad flows and lack of updates and flows can be a very expensive mistake for brands over the $10 million in annual sales mark. Then we'll be chatting about operating cadence, how strategic alignment should work inside of an e-commerce team. So whether it's your daily check-ins to your weekly and bi-weekly KPIs and how those get adjusted all the way through your monthly and quarterly planning. And then lastly, we'll finish off with what percentage of your ad spend should be allocated to creative development. So not just allocated to the advertising channels themselves, but into actually making the creative. It's been an ongoing discussion internally and sort of in the e-com world. So we want to touch on that a bit as well. But we'll kick things off with bad discounts. We had a post go out and it reads like this: Stop losing money with bad discount strategies. Rising ad costs is not the only thing that's hurting your margins. Higher CPMs have been the go-to narrative for brands over the last 5 years. I'm not saying that's not true, but while most brands have since recalibrated their growth model and expectations on the paid side, many have still ignored one of the largest cost centers to the business: discounts. If you're a founder, operator, CMO, CFO, here's a few things to consider before planning your next sale or promotional event. Avoid blanket discounts, focus on contribution margin, tiered up to discounts, volume-based incentives, product-specific bundles, graduated discounts, subscribe and save, and tracking the right metrics. Now, one bonus thing we include, and a lot of people don't mention this, I want to get your take on this as well, Liam. Don't believe everything you see in Shopify. If you're using slashed pricing, chances are your gross sales report straight out of Shopify is underreporting revenue and the perceived economic impact of your discount strategy. We see this a lot because a lot of the brands that we work with at Aplo, when they come to us, maybe they don't have a controller, maybe they don't have a financial team in place. So a lot of the times we'll be looking at reports pulled from Shopify that we can pull on it from our team. And a lot of the times, some of these economic impacts are buried in those reports. So that's the first post. Liam, what are your thoughts there on the discounting side of things?
Yeah, I think, the biggest one I think that is something that we see all too often is just the blanket discounting. I think a lot of times as brands mature and they grow and they become, mid 8-figure brands and above, a lot of times they've discovered that this is not the most optimal way to discount. But a lot of times in kind of that high 7-figure range, getting into the lower 8 figures, you still see a lot of blanket discounting happening for various reasons. Sometimes it's just from a time perspective on there and they don't have time to actually dive into everything. And it's just easier to slap a discount across the board. And you will usually see an uptick across the board in terms of the actual amount of sales that you're generating. But what that's actually doing and the opportunity costs of doing the blanket discounting, as opposed to really diving into what units you need to discount and what units you don't need to discount to move and achieve the same result, if not better, is something that we see a lot of. So I think you might notice that some of your best sellers really don't need to be discounted heavily to move the same amount of units, if not more units. Some of your underperformers, maybe that's what you start discounting very heavily, and you can use up to X% off language to get people into the door, click on your ads, click on your emails. And then in that process, you might still see your best sellers move at a high clip, even though you're not actually discounting them. You're just getting people to the actual site with that enticing offer. So that is the main one I'd like to focus on right off the bat because it's something we see a lot of. But curious your thoughts too, Jacob, if there's any point you want to elaborate on.
Yeah, I want to double click on blanket discounts as well. We see this evolution with brands as they scale, and I'll define scaling as either scaling in revenue, scaling in catalog size, or scaling in terms of the business complexity. So as a brand between kind of 1 and 5 million, we often see a lot of operators kind of stick to the coupon sort of approach. Not all, obviously. A lot of brands sometimes find that either the gross margins that they have on their product don't really allow for that type of discount strategy. So maybe they'll right off the bat have a BOGO in place, or they'll do the graduated kind of or tiered discount strategies. But a lot of brands, especially on the smaller side, they'll typically do coupon codes 20% off, 15% off, 25% off, and they'll do those site-wide. And it makes sense. It's really easy to communicate in an email. It's really easy to communicate in an ad. It's really easy to apply. You can do auto-apply links. You can have the little trick where you cache that discount at the start of the session, so you can hide a link inside your ad or inside your email that as soon as the person clicks and they start that session, that coupon's going to auto-apply at checkout. All of those strategies you can use, and they make it really, really easy for customers to go and redeem their discount. But then to your point, Liam, if you're just doing a site-wide discount, let's say it's 20% or 25%, you're likely over-discounting on certain products that you maybe otherwise wouldn't have to.
Mm-hmm.
So if you want to give away 25% on products that are slow movers, they're really not selling, you just want to clear that inventory, you should do that all day long because that's probably a good trade. But if you have hero products or new arrivals that you don't need to do that, maybe if it's a new arrival, you're already kind of low on stock because it's a bet that you're making into a new category or into a new product line, you don't want to be selling those units at a lower contribution margin than you need to. And for hero products that would sell at a 10% discount or at full price, you're also not better off giving that away at 25% off. So it's this asymmetry of like where you're discounting too heavily versus where you're not discounting enough. So we often say like if your catalog is growing and it's likely becoming a bit of an 80-20 where 80% of your sales are driven through 20% of your products, you should be heavily discounting the 80% of your inventory that's basically sitting and is non-productive, and you should be avoiding heavy discounts on the inventory that's actually driving sales that doesn't necessarily need the same incentive. Mm-hmm. And then depending on what you want your days inventory to look like and what your demand plan looks like, you want to also adjust what that pricing strategy looks like so that you can either drag out the number of days or turn units faster so that you can replenish that inventory. So whenever I think about discount strategy, that's where my mind goes. Now, obviously, you want to think about it also from like an ease of redemption standpoint. I think that's why people love coupons. That's why we see a lot of like smaller brands, as mentioned, use coupons. Yeah. It's easy for customers. It's easy for founders. It's easy for marketing teams. But as you scale, you're leaving so much money on the table, and in some cases, probably losing a lot of money by having these what we call bad discount strategies in place.
Yeah. I would just like to call like a really applicable example about this because I think sometimes people question the up to X% off strategy, and just kind of clients of ours oftentimes will pose questions about our recommendation there. Like if you just walk through a mall, if you just go to a mall and you look at all this, because it's the same idea, you have a bunch of customers and people walking around a mall, tons of stores that are getting people's attention. It's all offer based. And if you see those big signs on a lot of windows, that'll be like 40% off, 50% off, 70% off, etc. Most cases, if you look at it closely, there's an up to piece on it. And you go in and there's certain items, to your point, Jake, that are listed at that really high percentage off. And there's others that aren't even on sale. And this is consistent across a lot of retailers, even more premium ones. So it's something that even more premium retailers do. And so just wanted to like tie it into a very practical example that most people have probably seen in the physical retail world. Because it's the same idea, D2C. You're just trying to get people in the door. There's an offer that you want to present them. It's all offer driven to get the eyeballs on it. And then you want to protect your margin. And you don't want to, succumb to margin erosion by discounting things that you don't need to discount even to get people into the door. I think it's an interesting topic because there's so much in there that oftentimes is overlooked when it comes to actually being more intentional with how you do discounting.
100%. And just before we do, there's this one piece on the slash pricing side that often gets lost in those gross sales reports. So in Shopify, if you're looking at your gross sales report, what you're actually going to see is the listed price that it got sold for. So how does Shopify actually calculate gross sales? Super important for anyone who's looking to implement the strategy Liam's talking about. If you go into Shopify and you pull a gross sales report, how is Shopify calculating it? It's looking at what you had at checkout, so the order that was placed, and the price per line item. So if you take that price, it's the price the customer actually ended up paying. And if they stacked a discount code on top of that, it's going to be the gross sales amount, then your discount lines in the Shopify report, and it's going to get you eventually, after returns, etc., to your net sales figure. Now, the problem is, let's say your gross sales, let's say you had, a product that sold at $50, but its original price was $100. Your gross sales report is going to reflect the price at $50, not $100. So you have a 50% discount that is buried in your gross sales. So it's not a discount line on your Shopify sales report, but your actual economic impact is not 0% off discounts. It's 50% off. So oftentimes a lot of brands actually lose that visibility if they don't do the proper accounting behind what their real economic impact of discount strategy is. And again, it's something that gets easily missed if you're just pulling the report directly from Shopify. All right. So moving on to the next, why set and forget flows are an expensive mistake. Liam, you see this all the time with brands that you're speaking with and auditing. What are some of the things, I guess, that you see? And before you jump in, just to kind of tee it up for the audience, when you have 0 to 1 million in annual sales, it's okay to not have an email strategy. As a founder/operator, you have so much to figure out in those early stages. So figuring out technical nuances of email performance and flow strategy is not a high priority. But as you begin to scale, those incremental dollars driven through channels like email start to add up. Suddenly, 40% of revenue attributed back to email starts to matter a lot. But there's something else that happens in your business as you begin to scale. As your brand grows, you begin to notice the impact of returning customer revenue on your P&L. At first, it feels negligible, but over time, it becomes the overwhelming majority of your total contribution margin. Not enough people talk about this, but this is the returning customer revenue and contribution margin. This is the actual why behind channels like email. Email is not about spamming your customers with offers or putting together clever subject lines. The real value in channels like email is the role they play in consistently driving predictable and profitable return customer revenue. Liam, on your side, what do you think of that general take? And what do you see from your side with brands?
Yeah, I think like the main thing I want to touch on mine from that, and I think this is a lot of where it's coming from too, is the set and forget flow side of things. So a lot of brands just do not test flows consistently enough. If you just look at like everybody's busy, everybody's got a lot on their plate. Typically what you're looking for is the highest leverage activity with the lowest amount of effort that needs to basically go in to achieve whatever that outcome might be. And from a business standpoint, that's like the most efficient use of time for everybody. And everybody loves doing activities like that because of what it can actually output for a small amount of work. That in the retention world and email and SMS world is A/B testing core flows in your high leverage automations, because all of the small incremental gains you make within that core flow structure will amount to sizable amounts of revenue as you scale. And again, in most cases, a lot of these A/B tests can be fairly low lift from an actual effort and time and energy needed to be spent on achieving them standpoint. And the gains you can achieve from that are tremendous. One thing, just tying this back to a lot of what we always recommend, is in many cases, even, deep into the 8 figures, brands that we've audited that are around that size, a lot of times they still just do not have an actual regular A/B test strategy on the core flow side, simply because they think, okay, what we put in place, we've tested it before, it's working, set it and forget it. Some tweaks here and there, but more or less, we know this is working well. Let's like kind of just leave it run. If you take that same kind of outlook and apply it to the paid advertising side, you're always testing what's working on paid ads. You're always making little iterations, and those little iterations can allow you to achieve a lot more scale at a profitable or a positive contribution margin standpoint. The same kind of logic should be applying to your core flows on the email and SMS side. They're getting tons of volume, your things like your welcome flow, ban and cart, browse ban, things like that. And any little tests that you can make and have an actual plan around the tests that you're doing will allow you to then set a new baseline of, okay, this is what's working now. We provided incremental lift. Let's go beyond that again and see if we can continuously stack on those incremental gains, which is what you need to do on the retention side long term. And it's very high leverage. So
100%. I'm going to take a slightly other side of this. I completely agree on your comments around A/B testing. And the thing is that as your brand scales, as you grow larger, like that really starts to add up. Each incremental A/B test can actually amount to, over the course of a year, hundreds of thousands in either revenue or, depending on your scale, honestly, even contribution margin. So it's really, really important that this incremental testing happens. But from my perspective, the thing that's an even bigger mistake is brands set and forget flows that contradict strategies they're doing on the campaign side. So for example, they may be running sales that are like 2 or 3 week long sales, maybe even shorter sales. And there's no real strategy in place to align what you're doing on the welcome side, what you're doing across your recovery flows, so your session abandonment, your browse abandonment, your cart and checkout abandonment. Like those don't have updated creative, updated offer to reflect what's actually happening either on the paid advertising side, on the pop-up side, on the campaign side. And it just creates this like disconnect between all different points of the funnel. And what the strategy should really look like is a consistency, a congruency between all of these different parts of the funnel. You want to make sure that the offer that someone sees on an ad is the same offer that someone sees when they land on the page, when they get the pop-up, when they opt in, when they get the welcome email, when they go and click on the product and trigger the viewed product event and get the browse abandonment flow and the the product that they saw is the one that they see in the email with the offer that they opted in through. When they go and click on that and then add it to cart, the cart abandonment is the one with the same offer with the same product. It needs to be congruent all the way through, all the way to purchase. And then from there, it has to be a congruent post-purchase experience based on this is the product the person bought. What is the next most logical product or set of products to offer them? And one thing that we're doing with our brands is can we recommend products to customers based on what we know about our inventory and our demand plans? So for example, if we know that there are certain products that we're just way too overstocked on and we're willing to give away at 30, 40, 50% off, are those the products that we should be adjusting inside of our flows and surfacing those products as the next cross-sells in those product-specific post-purchase experiences? So there's so much there that brands oftentimes just kind of leave behind. Again, if you're between 1 and 5 million, maybe it's okay that gets left behind. But if you're doing anywhere beyond 5 million and even coming up to 5 million, these really start to add up. The best part about returning customers is that not only is the contribution margin generally better because you don't have that CAC side, but you have this mechanism to really get out of certain product lines, get out of certain inventory. You have a way to distribute that inventory to your existing customer base. So you may as well make these optimizations in your flows to actually move those units. So I just think there's so much opportunity that gets left behind. I think brands oftentimes either don't know it's possible or there's so much else happening at scale that the founding team isn't just as plugged in. Now, a lot of founders we speak to, oftentimes it's not that they don't know it's possible. They're actually very, very tapped into what is possible inside of these platforms. They just don't have the time necessarily. And their teams take a very set and forget approach because maybe there's also a time allocation issue happening, or they're just they've outgrown their partner at that stage in their business, whether it's agency or contractor or whoever's doing it at those early points. And as they kind of mature, get past that 5 million stage and into the 8 figures, that's where they really need to start looking and reassessing some of these sort of strategies that got maybe left behind.
And you're getting into just kind of the concept of merchandising your Klaviyo account or your ESP, right? Doing that correctly, which I think is something that really does not get talked about enough. And to your point, it's incredibly high leverage. So it's something that 100% needs more focus because again, if you can stack all those incremental gains, same way you look at CRO on the website side and testing landing pages and testing different CRO optimizations on the site, same logic applies to your core flow structure and a lot of the core flows within the email side of things. Because the goal there is really just getting people to click through the site. So it's something that all of these concepts and frameworks of how you look at these different channels, they somewhat apply to each other as well. And then a lot of times people do not apply that to the email and SMS side for whatever reason. It just is disassociated with the site. Because I guess it's obviously not the site, but it's an extension of it to a certain degree.
100%. The last thing I'll say before we move on is also the fact that your LTV or your business, your business's intrinsic growth rate is a function of your LTV. And what that means is that the free cash flow that you generate as a business in large part comes from the returning customer base that you've built. And again, it comes back to this idea that your higher margin revenue will be the revenue that's coming from returning customers because you're not reacquiring that customer, at least not at the same cost as a net new customer. So the larger you can build that sort of the more you can soak that sponge, the more revenue and contribution margin you can create to go and either subsidize future growth or just basically create more free cash flow for your business for distributions, etc. But if your optimization is grow as quickly as possible and you want to do that on what we call an unlevered basis, meaning you're not going to go and try to finance that growth through external capital, you need to have some sort of core kind of operating cash flow that's coming from the business. And that's often going to come from returning customers because the profitability of net new customer kind of acquisition it's just not as high. So it's going to make it a lot harder to kind of hit those scaling goals. And again, it varies by product category, but for the most part, I think that statement's true. Moving into the next statement. So Liam, this was a post from you. I'll read it out and then I'd love to get your take here. What is the operating cadence that is most effective for D2C brands? Having worked with 100 plus brands, we at Aplo have seen a lot of different structures when it comes to operations on the brand side. Weekly marketing meetings are the norm in D2C, but many times they can create more problems than they solve if you're not intentional about how you make decisions. Short-term check-ins make it too easy to overreact to noise, a bad day of ads, a dip in email performance, or a blip in contribution margin. That kind of knee-jerk decision-making is very likely to hurt long-term performance. We've seen that play out many times. Instead, the cadence we see work best is something like this. Monthly forecasting to align on actuals, contribution margin, and upcoming goals. This is where strategy development lives. Weekly or bi-weekly check-ins for things like creative, pacing, or channel updates. These things move without letting day-to-day noise drive strategy. Rolling 7, 14, 21-day views of performance instead of daily snapshots. This smooths out volatility and helps you make cleaner, more confident calls and avoid knee-jerk decisions. The best operators we've worked with know it's about setting a cadence that creates space for strategy while staying agile where it matters. Liam, what did you mean by this post? I think it's pretty clear, but would love to get your thoughts.
We've had the opportunity of working with well over 100 brands, and in doing that, we've seen a lot of different structures in terms of how internal brands operate. And through that process, it's also shaped how we recommend going about our decisions as well, and the service provider to these brands. So we have a really interesting, like, high-level snapshot of a lot of different ways to operate D2C brands and a lot of different ways to make decisions. I think something that's very consistent with all of the best brands that we work with and have worked with, and the best operators we've had the pleasure of working with in some capacity or chatting with, is that they understand time windows on which they want to make decisions and really sticking to that. Because if you continuously are flip-flopping between the amount of time between when you make decisions, obviously, if there's always edge cases, but if you're continuously flip-flopping around that, you're going to be in a situation where you're making decisions on a time frame that's not consistent, which is going to lead you to making knee-jerk decisions based off of a day or a couple of day of bad performance, et cetera. And one of the most applicable things to this kind of concept, and something that we've seen a lot of, is this kind of fallacy where, let's say you have, let's say it takes a handful of days for people, once they see your ad, to actually go and purchase, as an example. Let's say it's 7 days on average, something of that nature. And you're spending a ton of money and you pull that back really aggressively. In the next 7-day period, you're not spending as much on ads, but you're still reaping the rewards from the previous 7-day period when you're spending a lot. So profit goes up, contribution margin goes up, you're acquiring a ton of customers. And sometimes people will look at that and say, whoa, like, we dropped spend, and clearly that's the route that we need to go, is continue dropping spend because we're way more profitable and we're acquiring a ton of customers. But in reality, that's not actually the case. The case is that you're still reaping the rewards of that previous 7 days worth of spend. And so if you're not analyzing things on a longer term time frame, you get kind of caught in these little pockets of essentially these fallacies where you're kind of getting like
confirmation bias almost.
Exactly. Yeah, that's exactly what I was looking for. You're getting confirmation bias on decisions you're making, but that's actually not the reality. So I'm kind of rambling a little bit on that point, but that's something that we've seen a lot, time and time again, is just the best operators really understand the time frame on which they need to make decisions, which is easier said than done. Because obviously when things look like they're not trending in the right direction, you want to make an immediate decision, especially when you're a D2C brand. And one of the main ways in which you're acquiring customers is spending a lot of money every single day. It's really difficult to do. But if you can get into a good cadence of doing that and actually trust the teams you're working with, usually long-term, that's going to amount to a much, much clearer path. You're going to get cleaner insight into the data and performance and be able to make better decisions as well over time. And that's all going to compound.
No, it's a great take. I actually want to take this back to the email side. I mean, something that we see all the time, Liam, is like this relationship between percentage of email revenue in relation to top line revenue. The percentage of revenue is kind of deceptive, right? Like if you pull back spend and you stop acquiring customers, but you have this like large base of returning customers, for example, that have built up in your email lists, the campaigns you're sending, the flows that are still queuing these subscribers that you've already acquired and kind of have entered the funnel, you're going to see this massive jump, for example, in your month-over-month percentage of email revenue. And oftentimes brands can look at this as a KPI. They'll see, for example, oh, we went from 30% to 45, 50%. And that looks like a really positive kind of step forward. It must be that we're doing something right this month on email. It must mean that like it's working. In reality, what it actually might mean is that you've just had a displacement of new customer revenue versus returning customer revenue, and you're just starting to see the lagging effect of that show up in what percentage of email revenue has engulfed that, otherwise like top line figure. And at first it might look great, but, a few months down the line, it takes a few weeks or months to see the residual impact of that. And that oftentimes is
100%
fewer customers that you've acquired in that time, therefore fewer subscribers who have gone through the funnel, therefore less revenue on the returning customer side because the sponge was actually not soaked. Mm-hmm. And on the top line side, well, just a smaller nominal amount because you've stopped acquiring new customers. So your top line revenues shrunk as well. So we see that a lot, and that relationship needs to be carefully understood, which is why making sort of large decisions around spend and acquisition based on very limited data, potentially statistically insignificant data, can be risky. But at the same time, you have to be agile. You can't just let, for example, data or performance run without any accountability and not adjust to the game on the field. So it's a constant balance. And I think we as the agency kind of sit in between that, where it's really a decision of like, okay, is this significant enough to warrant action? Or is this turbulence where we should expect turbulence, but we should stick the course and hit our ultimate target by the end of that month?
The last thing you just said there, Jacob, is really, really key to the first bullet point in the post I made, which was the monthly forecasting to align on actuals, contribution margin, and upcoming goals. This is where strategy development lives. Great point there, because essentially what you're looking to do in this kind of structure I've laid out that we see work really well is you have a monthly discussion going into the month or at the start of the month. This is the expectation of what we are likely going to see during this next 30 days or so. This is the fluctuation throughout the month that we might expect to see as well. As you go through the month and see how you're pacing, you can always reference that and understand, okay, you know what? There's a blip right now, but we're still pacing to hit what we expect to hit. This is all good. Let's stay the course. Obviously, if there's 7 days go by and we realize that, okay, we are clearly not pacing in the direction that we want to, that's when you can start making a decision. But if you actually always relate it back to that initial forecast and discussion you had, that allows you to be much more intentional with how you go about making decisions as well. And also, to your point, sticking the course if you're relating it back to something that you expect to happen. 100% agree with that.
100%. No, super well said. Last topic we'll move on to is the percentage of ad spend that should be allocated towards developing net new creative.
Cool.
So Liam, you put out a post recently. What percentage of ad spend should you be budgeting to develop new creative? Our most recent episode of the Ecom Scaling Show, some great discussions were had here about how 8-figure D2C brands should spend on ad creative. So of course, Dylan, one of our co-founders, and John, partner and founder at Free to Grow CFO, they had a chance to sit down and chat through this. But Liam, how should brands think about this? I mean, one kind of heuristic we here at Aplo use is between 5 and 10% of your ad spend per month should be roughly allocated to the development of net new assets. And now, whether that's, for example, partnerships with creators, whether that's organizing shoots, for example, whether that's just the volume of ads that you're actually creating through your agency, whether it be us, third-party agencies, ideally you have multiple sources of creative, both internal and agency-wise. So I guess, yeah, how should brands think about this from your perspective?
Yeah, I think, again, it's whenever you get into discussions about like what's the rule from a percentage standpoint, it's always, again, there's always edge cases. It's not going to apply to every single brand. But in most cases where this is coming from and what Dylan and John were talking about is the best brands out there that we typically see usually are allocating roughly that amount, 5 to 10%, 10% being a bit of the higher end, on developing new creative. And that can be, again, like that's, to your point, Jacob, that can be agencies developing creative, that can be doing internal production, that can be working with influencers and content creators, et cetera. So it doesn't all just have to come from one source. And continuously over the past little while, a big trend in the D2C space that most people have been talking about, a lot of people have been discussing this, is just the diversity in which you're sourcing creative from different parties to make sure that you're always putting forward your best foot from a creative standpoint, because it is one of the biggest levers to pull. The most important piece of all of this, especially when you get into discussing different lanes of creative, is actually having some creative strategist and somebody in that position that's sitting in the middle of all of those channels of creative to coordinate what we need, what needs to be done, and understanding this party is responsible for creating these types of assets, this party for these types of assets, and having that all come together in some sort of creative production pipeline. So that's one thing that at Aplo, we really focus on with our creative strategy team, is being in the middle of all of that. Because once you have all of these different parties making creative, you need to make sure that you're actually making the most of all these different parties and making sure that you're not doing double work, so to speak, and not getting the most out of that 5 to 10% that you're allocating to creative, because that's a sizable amount, especially when you look at it as a percentage of revenue. Yeah, it's one of the biggest levers these days to pull, and has been for quite a while, but of course it's incredibly important now. And I think having a diverse stream of creative is important. Ballpark range of 5 to 10% is often what we see 8-figure brands spending on developing new creative.
Yeah, 100%. I'll just add that like the 5 to 10%, like you said, it's such a loose kind of target. It's just a heuristic, right? But if you're spending $100,000, for example, per month on ads, that maybe lands you between 5 and 10,000 should be allocated to net new creative development that month. If you're spending $1
I said
million on
revenue. I
ads,
didn't want me to, I just realized, Jacob, I said revenue, I meant spend.
yeah, if it's pegged to spend, let's say it's 5 to 10%. That means if you're spending $1 million on ads versus 100,000 on ads, well, if you're at $1 million a month in spend, that probably means you're landing between 50 and 100,000 in sort of net new creative development budget, let's say, as a heuristic. And over time, as you kind of continue to scale, like that probably starts to cap out, right? Like the diminishing returns on, trying to hit a 10% or 5% target of spend maybe is not worth it, as you continue to spend into the millions. But there is some sort of optimal kind of number where, as a sort of low to mid 8-figure brand, you want to be keeping that kind of that range, and from there it really just becomes a continued discussion with the creative strategy team. How should those dollars be allocated towards what concepts, and so on.
Yeah, and I think the one thing too, just to like double click on Jacob, is averages are misleading in pretty much everywhere. Averages are misleading, so you need to look at your own situation to understand, like, okay, what makes sense. But it's a good benchmark to kind of understand where do you fall, and what we typically see D2C brands allocating to spend. So yeah.
Well, awesome, Liam. I think we got through all the topics on the docket today. Before we wrap, how can people find you? What's the best way to get in touch with Liam, whether it's on LinkedIn, through the website, etc.?
Yeah, I mean, but we called out both the best ways there. LinkedIn and the website. We have, we urge people to subscribe to our blog and our newsletter. We cover a lot of these types of topics in detail there. Obviously, we try and do it via these types of videos as well. And then, of course, call booking links all over the website and on LinkedIn. So if you ever want to chat more about it, happy to chat too.
Awesome.